My name is Kyle Kite. I am the Director of Financial Planning here at Klaas Financial, as well as a financial planner on our team as well. Joining me today, the main presenters are going to be Nate Brybe, who is another advisor in our office here in the Loves Park office, and Josh Sterling, who is a portfolio analyst on our in our portfolio management group. He's based out of our Madison office. So those will be your three main presenters. As I said, I'll be checking the chat and the Q&A boxes if you guys have questions. And we're going to be recording this to post it on our website at a later time. So I will start off by giving you guys a little bit of an introduction on who Klaas Financial is. For those of you that haven't worked with us before, most of you are clients of ours, so hopefully you know what we do by now. But we've been in business this is our 46th year. We were founded in 1976 here in Rockford, Illinois, by Craig Klaas and his brother Palmer, and we've been in business ever since then. We've been in the Madison market for probably close to 15 or 16 years at this point. So those are our two offices. But we have clients that have spread out all across the nation. You can actually go on our website. We've got a pretty cool little map where you can see the states that we have everybody where they've moved to reside in permanently. Obviously, Wisconsin and Illinois aren't the best climates for retirees once you can get out of here and get away from some of the cold weather and the ice that we're having today. Obviously, we have a ton of snowbirds as well. So we've been in business 46 years. Like I said, we are what they call an independent wealth management firm. So independent means that we do not use any proprietary products. So pretty much anything that we have in our portfolios, you can buy at anywhere, a Vanguard or iShares or anything like that. So, and we also don't have a bank looking over our shoulder telling us that we have to use certain investments or anything like that. So being independent allows us to truly pick the best investments for our clients. And that's what we believe in. We will get into some more in-depth explanation of kind of our investing process. A lot of you that work with us this will be kind of a repeat of what we kind of talk about as you guys come in for your reviews on a frequent basis. But for something that we've kind of been branding ourselves here recently is that we do have multiple divisions. So the two main divisions is what we call KIP, or Klaas Investment Portfolios. That is the way that probably 95% of our clients work with us through. And in that division, we work as your coach and your quarterback. So not only do we help come up with a financial plan, but we also help you implement that financial plan. And part of that has to do with managing investments and things like that. The other division, which is a little bit of a newer division, and we've had it for probably 5 years or so at this point, is called Klaas 360. And for that division, for those of you that maybe work with us through that division, we work as what we call your coach. So we help you come up with a plan, but then we kind of leave it up to you to implement our recommendations as far as the planning aspect and the investment management piece. So like most of you are aware, we are heavily focused on the financial planning of your retirement plan, and designing your best retirement is our goal. So our niche is retirement planning, getting people to retirement and then helping them throughout retirement as they enter the distribution phase as well. So that's a little bit about us. Like I said, it may be a repeat for those of you that have worked with us for a number of years, but that's how we want to get it started. And now I will turn it over to Josh, who, like I said, is our portfolio analyst with our portfolio management group.
Thank you very much, Kyle, and welcome everybody. Today, Nate and we're going to talk through some of the investment management, some of the beliefs that we have behind the way that we construct portfolios. We're first going to talk about the building blocks of how we build out portfolios. So we'll start off very basic and add on layers to that as we go through. Later on, Nate's going to talk a little bit about some of the asset allocations that we have, some of the investments that we have, how that might apply to you or somebody different from you. And then later we'll talk about why you might consider a portfolio manager. So whenever we talk about investments and building out portfolios, it's always important to start, again, like I said before, out with the building blocks. We're going to start off pretty basic today. So from a very basic standpoint, which many of you might already know about the difference between stocks and bonds, but to kind of level set a little bit and talk through this, you have basically two different ways of investing with a company. You have stocks, which is equity ownership in a company. You basically own a certain percentage of that corporation. And you have bonds. And the easiest way to think about bonds is like having a mortgage with a bank, except a company is in debt to you. And with a bond, basically, they will give you coupons or interest payments every 6 months to a year. And a bond is an obligation. It's something that they either have to legally pay back, or kind of like you and I have a credit score. They have credit scores as well that they need to maintain and keep stability to. So when we look at bonds and investing, they tend to have a lot more stability over stocks. Because with stocks and ownership in a company, there's no guarantees to that. Bonds have not guarantees, but obligations or repercussions to the company if they don't abide to those. So with stocks, the biggest benefit with a stock is the growth that you can expect from a stock over time. Companies tend to grow as they create new products that produce revenue, that produce value in the company. As that company grows and gets bigger, so does your share price and your stock that you have. That's a big benefit over bonds, where bonds, the only expectation that you have is just that interest payment that you get every 6 months to a year. With stocks, there is an opportunity for dividends for some companies, but the biggest opportunity within stocks is the growth of that entire company and your stock price going up. However, with stocks, like I said, there's no guarantee to stocks. So the worst thing that could happen is a company goes under and you lose your investments. With bonds, that's much less likely that it's going to happen, because bonds have obligations, they have to make their interest payments, and they have to pay you back eventually. And if a company were to go through bankruptcy, there is some obligation that either a portion or the entire portion that would have to get paid back. So when we look at investing, stocks offer a really great tool for incredible growth over a long period of time. But we utilize both of these because in tandem, they work really well together, having a good opportunity for growth with stocks and having stability with bonds, making sure that you get both to have stability and great growth opportunities over a long period of time. As we go for it, Nate.
Yeah, I was just going to comment on expected returns. So I think as an investor, it's important to understand kind of the risk reward trade-off between the two. And Josh made an excellent point. When you look at a bond, all you're truly expecting is to literally clip the coupon. You know, way back when that was literally a thing, you would redeem the coupon of a bond certificate at the bank and get your interest. And if it was $100, that was your retirement budget for that month or year. Okay. So really, when you look at a 10-year treasury, or, you know, bonds come in many different shapes or forms. Okay. You can buy it, you know, from the government, the US government, an international government, a municipality, a university, a corporation, you know, you name it. Okay. All we should expect if we hold that bond to maturity is that coupon payment. And that's a fancy way to say interest. Okay. So Josh, is the 10-year treasury at 2% or something around there?
Yeah, I think it just broke 2% about a week or two ago.
So if you loan your money to the US government, you're going to get 2% per year for the next 10 years. Okay. And this is easy to understand when you literally buy an individual bond. It's a little bit more difficult when more commonly you own a mutual fund or an ETF that invests in a basket of bonds. Because we're seeing that recently to start this year where, you know, bonds do change with interest rates, okay? And if we're seeing increased pressure on the Fed to raise interest rates, bonds react and reprice to that. So as you see your statements and you say, well, wait a minute, I was expecting just to get my coupon payment from the bond, but my price is down a little bit, that can change things too. So there are, you know, price fluctuations like Josh has on the slide, you know, to your bonds. Okay. And admittedly, it is hard to understand that when you look at a diversified, you know, ETF or mutual fund. But more so when you have an individual bond, it's a little bit easier to see. So
the other big thing with the difference between bonds and stocks is their ability to outpace or match inflation. That's something very real that we're going through today. A lot of people have a really good proportion of their investments in bonds or fixed income. And that could be a struggle during high inflationary environments. And it's something where stocks can have a lot of growth and an opportunity to kind of offset that inflation that you might be dealing with.
Yeah, I have a couple of comments on that, Josh. if we look at, let's switch to the stocks now. Let's look at the average return. We'll use the S&P 500 because that's a broad, that's a US index of 500 large stocks in the US. That's a good kind of benchmark. If we look from 1926 to the end of last year, it averaged about 10% per year. Okay. Now there's a couple of different things about averages. If we have these 2 points in time, we can draw a nice, pretty straight line, right, and say this is the average return. But I'll tell you, only 7 of those years actually had a return in that 8 to 12% return range. Okay. So I think that's important for all of us to keep in mind. If we're in stocks, if we're in equities, as we're experiencing to start off this year, it's not a straight, pretty line where we're going to make 8% per year. Okay. Or whatever that number is. So that's why we say the price fluctuations are high. That being said, what drives long-term growth of the stock market or of stocks? We believe it's profitability and earnings of the company. Because if you're actually buying a share of Apple, you better, that's how owners get repaid on their investments, that they physically make a durable profit, selling a good or selling a service, and that generates profits to the shareholders. Okay. So for example, last year, or the end of fourth quarter of 21, the S&P 500 is projected to grow earnings by about 30%. Okay. So now that's not saying the market's going to go up 30% in 2022, but that's the justification that's there. If stocks, that the company literally made 30% more in profit, you can make an argument that there's a potential for their stock price to be reflected somewhat by that. Okay. So that's important to understand. That's what we believe the main driver is. There's a lot of other factors that come into that and things like that. And short term, it's not a pretty picture, a perfect picture of how, why it goes up, downs, or sideways. But over the long term, that's what we think the main driver is. Because it makes sense, right? Josh will have this on the next slide about a couple of stocks, but why would you invest in something that literally loses money, right? That doesn't make any sense. If yes, there's potential for growth in the future and things like that, but just looking at it from one day, it's hard to make an argument for buying anything that literally loses, money in that sense. So.
Absolutely. I think one common thing that you'll hear a lot from any investment professional is diversification is key. And a lot of times it could be difficult to kind of understand truly what diversification means. So we're going to go through 2 examples here of what diversification means. We're going to first take a look at what is stock diversification at a very basic level. And then we're going to look at what does diversification mean within a portfolio. And so on the screen right here, what we're looking at is a period of time over the last 5 years. We'll take a little time trip here, and let's imagine that we're back in 2017 with $100,000 to invest. And we have these 3 different options to choose from. We have General Electric, we have the S&P 500, which is the US largest 500 companies, and then Amazon. And so you look at this here, and it's pretty easy to pick the winner. It's pretty easy to look at this graph and say, you know what, I think Amazon is a solid pick. But hindsight is 2020. You look at this and say it's easy to pick. But when we time travel back and we put ourselves in 2017, I mean, you can come up with a narrative to why any of these, why GE or Amazon could be the next winner. Back in 2017, we were doing well coming out of the financial crisis on a really good roar for a while. GE was finally getting into a good financial position and doing pretty well. But of course, over the next 5 years, had a couple of issues that came along. They started having to trim back different segments. They started having to do layoffs, major restructuring. And so they had a devastating path over the last 5 years, almost losing about 50% of value. But we could almost flip the narrative on that. We could change the headlines a bit and see a different world looking at the point in time in 2017. We can imagine 5 years out, GE doing wonderfully, developing new segments, increasing the revenue over time, and really showing the strength of a conglomerate company. But of course, that's not the reality that we live in today, but we could picture it back in 2017, what those headlines could look like. The same thing with Amazon. I mean, it has been incredible over the last 5 years. It's opened up new headquarters in Seattle. It has opened up new segments of revenue. It has done incredibly well. But I mean, we could flip that narrative again. We could look at it back in 2017 and we could say 5 years out, I mean, what if they created too many new segments and they stretched themselves too thin? They might have matched the S&P 500 or done worse. And so it gets really hard to say this point in time, I know that this company is going to do incredibly well for the next 5, 10, 20 years. So I'm going to put all my eggs into that basket. And because it's so challenging to do that, indexing has become a very popular method of investing. And what we're looking at right here is the S&P 500. And it's the average, essentially, of those 500 companies over that time span, where if you would have invested $100,000 in 2017 in the S&P 500, you would have had over $200,000 within 5 years. That's pretty incredible. I mean, it's not a grand slam like Amazon did. The likelihood of being able to pick and choose the winners that are going to have that grand slam can be really challenging. Now, of course, we just picked up a handful of companies here. But I mean, there are many companies that have risks that we didn't even know could have been a risk aside from just losing revenue. PG&E, an energy company out in California, of course, had a major impact and caused the wildfires in California. Back in 2017, they were trading at a high just over $70 a share. Now today, they're trading around $10 a share. And it's one of those things where it's not necessarily that you're able to predict that. I mean, a utility company like that typically is pretty stable, produces a really good dividend over time, and is a solid investment. But there are many companies out there with different risks that if you have all your investments in, can expose you to something that you might not be aware of. And so being in the aggregate, the S&P 500 or a large diversified asset class like that, an investment, gives you the opportunity to kind of bypass those big negative drawdowns from being invested in just 1, 2, or maybe 3 companies.
Josh, do you want to talk about, I think it's kind of good for clients on the call to understand that, the S&P 500 is market cap weighted where, say a new, technology or you name it comes along and, I think I really want to buy, the new electronic vehicle stock or the new cryptocurrency or whatever, if that becomes part of the market, that will become one of the 500 largest companies and you own some of that. So it almost has this self-building factor of we don't have to pick the next best thing, the next new thing, because if it does become the next new thing, it will become part of the S&P 500.
Yeah, that's a great point.
Kyle, I think you have a comment about Sears, right? It was probably up there and.
Yeah, this is a very short time frame, guys. When we're looking at this, 5 years in the stock market is not a long time at all. But I'm sure most of you can remember when Sears was kind of the big retailer back in the 70s and even before then, the 50s. You could buy a house out of Sears. So to think about them 50 years, 60 years later here, basically being bankrupt and not worth hardly anything, that can be hard to fathom, right? So and there's numbers and difference of companies that we can talk about. Apple, you had to hold that basically to bankruptcy in the early 90s before it came all the way up now. And it's important, like Nate was just saying, with the S&P 500, any type of indexing where you buy kind of just whatever the best companies are, you're going to get your exposure to that. So like, for instance, our portfolios have the S&P 500. So guess what? You own Apple, Amazon, Netflix. They're called the FANG stocks, right? Facebook, Google. They were all part of the S&P 500, Microsoft, and they're part of what's driving this higher. So you have your exposure to all of these, but you have 500 different ones, not just one here or there, that can definitely get kind of wiped out over time. And there's a lot more companies that go bankrupt than become the next Apple or Google or whatever it is. So
if you want a fun experiment, look up the Dow 30 companies in 1980 versus last year, and that will tell you exactly what we're talking about, because you'll see some names on there that you remember and you'll be surprised by what has replaced them. So
yeah, and sometimes you don't even need to go that far back. From decade to decade, companies change. The largest 5 companies, the largest 10 companies will change constantly. Looking back 10, 20 years ago, Amazon wasn't even on our radar. These companies come big, and are a big part of our investment portfolios. And being exposed to all of them can be a great driver of returns over the long-term period of time. But What we're talking about right now is individual stocks. So what Nate just changed over to here is portfolio diversification. So this is an example of the way that we might create a portfolio investments. And what we're looking at here is two different investment types. So over on the left, we title it basic 60-40 portfolio. That's 60% equity, 40% fixed income or bonds. We keep that one pretty basic and simple. It's the US large cap, which is the S&P 500, just like we were showing on the other page. And then it has exposure to the US government and corporate bonds in the United States. Now, we'll compare that over to our globally diversified portfolio. And you'll notice there's a lot more segments, a lot more slices in the pie. And we do that because it gets us different exposures to different areas. The United States large companies is a very small segment of the investable universe. There's so many different companies out there in the United States and across seas. And it's important to get exposure to a lot of them, as many as we can, because not every company or not every kind of category of companies is going to be the winner at all times. And so what we do is we make kind of little small bets on all these different areas. So on our right, in our globally diversified portfolio, we still have a really big investment in US large cap, but we also invest in small companies here in the United States. We have a little bit of international exposure, some emerging markets, and we even have real estate within our portfolios. And the whole goal of this is that not every single investment is going to be the best investment at all times. They're all going to have their times when they perform pretty well. So up at the top here, we have a few numbers that I'll kind of point out. The one thing I'll point out is that the time frame we're looking at is almost a little over 80 years, from 1940 all the way up to the end of last year. So on the left with our basic portfolio, the two things we'll look at first are the return and the risk. The return annually over that time period for the basic portfolio is 9.2%, and the risk is 9.5%. When we go over and we look at the globally diversified portfolio, our goal should be to raise the return a little bit, but lower the risk. And we can see that we've done that. We get a little bit better return and a little bit lower risk, which is a great thing. But you can look at this and say, Josh, you know what, that's not that big of a difference. Like they're very, very similar numbers. And that's absolutely right. So the third thing I want to point out is the worst 10-year return. And this is what the point of global diversification means. When we look at any point in time over this 80-year time span, if we look at you invested at this one point in time and waited 10 years, and at the end of 10 years, what did your return over that time frame look like? That's what we're looking at here, but we're looking at the worst instance of that. And so with the basic portfolio, you only have 0.7, about 1%. And that's an annual return that you get from that investment. Now, when we look at the globally diversified portfolio, it's over triple that. It's 2.5%. And the whole goal of that is that we have all these different underlying investments that are working at different times. They're not all invested in the same kind of category. And so when you have the US large cap, it is pretty isolated in one universe within the investable universe. And so you end up when that doesn't perform fairly well, and the time frame that this worst 10-year return for the basic portfolio is looking at is between early 2000 to just around the Great Recession. That is commonly referred to as the lost decade. It happened right after the tech bubble, and the S&P 500 was hit very hard. But when we go over to the globally diversified portfolio, that one was not hit as hard. And it just shows that what we're trying to do when we build out these portfolios isn't to hit a grand slam every year, every other year. We're trying to build out a normalized, smooth investment experience as much as possible.
I would say a couple of comments here. The first thing, piggybacking on like US large cap, you know, if you're truly globally diversified, like Josh is showing there on the right, you're going to own a lot more than US large cap. And kind of when we, if, we follow the market and we look at the Dow or the S&P, most likely that's going to relate to most of your large cap exposure. So that's why it's very hard for people to understand that the Dow went up 600 points, or the S&P went up, 2% or down or what have you. It's not directly correlated to, a globally diversified portfolio. So, and that's by design, because, there's this concept called correlation, where basically, we don't want everything going up together at one time, because then it could obviously go down together. So on one, part of your portfolio zigs, the other zags. That's how you get better risk adjusted return, and how you get, positive returns and challenging times in the stock market too. So, over on the left, this is kind of how we would potentially see a do-it-yourself investor, which is fine. Someone who's picking things in their 401k, you could say, well, yeah, I got my 60-40 split between my stocks and my bonds. Well, yes, but there is more than just stock and a bond. Okay, there's different sub-asset classes within that general category. Okay, and there is a recipe, a method to the madness of why these percents are a certain percent. Okay, some perform whether under certain conditions, and like we said, they offset each other and kind of balance. So there is a lot of science and math as to why you have 3% or 5% or what have you, and that's kind of where a portfolio manager helps and makes those adjustments. So.
Mm-hmm. Yeah, one common thing that we hear a lot about is the U.S. has done so well. Why would you be invested in international investments? And that is true. Over the last 20 years, the United States has performed really well from an investment standpoint. But when you look beyond that, like Nate said, there's a zig and zag. At one point, international investments perform really well for a 5, 10, 15-year point of time. And then it kind of passes off to the United States, and it kind of goes back and forth. So having access to both inside your investments is a great opportunity to kind of smooth out that ride over the long period of time.
And I would say put it more simply is, we're investing for the future, not for the past. Okay, so we can look back and we can make the best portfolio over the last 100 years and say we should have done exactly this at this exact time. But guess what? We're not. We're investing for the future. So that's why when we hear things of, just like Josh said, strip out international, we shouldn't have any bonds because of X, Y, and Z, you name it. That's great. And it probably would have worked well when you knew what was going to happen, but we're investing for the future and we have to understand that too. So, which is always uncertain, no matter, who will tell you what. So.
Yeah. As we move ahead, the one thing to keep in mind, what we've looked at here, the last slide was looking at a 5-year time frame. What we're looking at right here is more than 80 years of data. Nate, I think you're about to go over this, but we're going to look at very narrow time periods going forward here.
Yeah. So this is a fun scatter plot chart, I think it's called. This looks at kind of our 10 or 11 portfolios that we offer here at Klaas Financial, kind of looking at different risk levels, where we look at, anywhere in this light blue on the left-hand side being 100% bonds, all the way over to the right where the red would be in 100% stocks. And what this does, this will chart the total annual return over the last 15 years or so, since 2007. On the vertical axis, and on the horizontal axis being risk. Okay, so it's not all about risk. It's not all about just total return. Obviously, we're smart enough to understand there's risk that comes into play with investing. And how we frame it with clients is saying, well, you may have money in your 401k or with us or with a different firm, and you can say, well, they made me, or I made 20% in my 401k last year, and you guys only made me 10, or whatever the number is. And just looking at return in a vacuum is not an apples to apples comparison. Okay, I always say it's like saying your Corvette is faster than my truck. Well, that's not necessarily a fair trade-off. Or if you drive a fast motorcycle, well, it's a little bit more risky being on 2 wheels without a seatbelt, and I'm in a big 4x4 truck. So you can't just view returns in a vacuum. And what this shows is, this shows the different portfolios, like I mentioned, where at a certain point, as you get towards these greenish yellowish colors, you notice you stop moving up incrementally with return, and you actually start getting more risk when you move out more to the right here. So it's not always about maximizing the total return, when we realize as we get towards the higher end of the risk spectrum, having more stocks, that we actually bring in much more risk without gaining much more return. So that's really important to our retirees who are looking to us to generate monthly income for them. If you're younger and you're growing your portfolio and you have a high risk tolerance, this maybe isn't meaningful to you, and it's fine, seeing the fluctuations. But when you're drawing on your portfolio, that's going to be the next slide here when we talk about, so far we've just been talking about, total returns. Well, to get 8 or 9%, we have to see some potential drawdowns too. How comfortable are we with that? So, Josh, any thoughts there?
Yeah, so I think sometimes you might look at this graph and say, well, when I look at the 70% equity versus the 80% equity, it's only a little bit more return for a lot more risk. But when you invest in these tools over a long period of time, 10, 15, 20 years, an extra 0.5% of return, an extra percent of return, if you're not making major distributions out of that account, it can be really powerful. Compounding is a term often used in investing, where you have $100,000 and 1 year you earn 10%, an extra 10% return on that in the following year brings that up to 121,000, and on and on and on and on. So when you get into these higher risk, higher equity investment solutions, that compounding return makes a big, meaningful impact over a long period of time. So if you don't have an immediate need for the investments and you're willing to invest for 10, 15, 20 plus years, and you're comfortable with the fluctuation of the value of that account going up and down, being in something more aggressive might have a lot of benefits to you. So it might look like a tiny marginal increase in benefit, but it can be powerful over a long period of time.
Yep. We'll switch gears here to asset allocation and drawdown. So this looks at 2008, which is kind of still in our memory of, I don't want to lose everything like we did in 2008, like we heard. So this shows the maximum drawdown in 2008 if you were in the NASDAQ, which is primarily a tech focused index. And as you know, that actually went down 50% in 2008. So, rationally, we may just think like, okay, well, that's bad, but I just got to make 50% to get back to where I started. Well, that's not actually the case. If you have $10,000 and it goes down to $5,000, you have to make 100% to get back up to 10, right? You have to go from 10 down to 5 to go to 10 has to double. That's 100% gain. So that is significant. That is very, difficult to do. It's certainly over a short time period potentially. So, and especially think about if you're drawing, 5% off to meet monthly income or something in your retiree, that can have a devastating effect, especially early in retirement. So, not to say, if we look on the right-hand side, diversified portfolios are not immune to drawdowns. And this just shows you, even if you are, moderately invested, like we described this portfolio potentially, it still can go down, 30%. No one likes to see that. That's how it works. But, on something like that, to break even, it's a 43%, recovery. So still, big numbers there, but this just understands how, the why. So this, I think, top of my mind is, we get a lot of calls of, man, my bonds really aren't doing much. Interest rates are going up, inflation's high. I'm not really seeing much returns. Well, it's not all about the return. It is about the risk management side on the drawdown too, that can help protect you as well. So.
And it's important to know, guys, everybody wants to make as much as they can and not lose anything, right? The problem is that doesn't exist. Trust me, every one of us at Klaas would love to give you a guaranteed 5% a year and no ups, no downs. It just straight goes up at 5% a year. But unfortunately, that doesn't exist out there. So that's why you have to get the type of return that you're looking for, but it's how much risk are you willing to take? And that's why these drawdowns are so powerful for people. Because again, it's easy to say looking back that, oh, if I was a little more aggressive when it was going up, I could have made that extra 1% or 0.5% that year, but it could have went down an extra 20%. And that was that one real bad year. And it does take a long time to recoup that. So this is why diversification is so powerful and why we're such strong believers in it.
Yeah, Nate, I think you brought up a good point. We don't like to shy away from these facts. I think it's important that everybody recognize and realize that with investment comes risk. And the risk is that in a year, you could have a big negative moment. But the important thing is to hold tight, stick to the plan, and to kind of ride it out. It's never a great thing to hear, but it's so meaningful 2-3 years later when your portfolio has more than made up for that loss. But we want everybody to recognize that these realities exist, and in the moment it can be pretty scary.
Yep. Switching gears here, I love this slide. This is great. So this talks about, common question would be, well, how should I invest my money? And, of course it depends, but this really does a good job of, explaining why. Okay. And some people use the rule of thumb of, use, or what is it? Take your age minus 100. That's the amount you should have in stock. It's like, well, that sounds good. And I can make sense of that, but that doesn't make it right. Okay. So it all depends on, we always, start with a financial plan of, okay, where you're at now, where are you trying to go? Where does this portfolio fit in that plan? And what does it need to do to reach your goal? Okay. So the first thing there would be time horizon. Okay. So one is, yes, retirement date. If you're 50 and you're going to retire at 60, okay, that 10 years, that's helpful. But as we're showing here on the left side with this teacher that's transitioning into retirement, what if that her pension and her Social Security covers all her living expenses? And her goal is to focus on legacy planning, we'd call it, and charitable giving, okay? So she doesn't need to draw from her invested portfolio, okay? So that is completely different if she came and said, well, no, I need $2,000 a month from that portfolio, Josh. Well, that changes our recommendation, okay? So it's not, Mary down the hall in first grade retired and she did this, I should do that, okay? Just because you're the same age, same profession, and been teaching for 25 years does not mean you follow that advice, okay, that someone else did. It can be the completely same peer, same job, but it could be completely different. What if she has a mortgage payment still and bought a condo in Arizona and golf 5 times a week? All this stuff factors in. And that's why we always start with a financial plan to say, where you're at now, where you're trying to go, what do you have set aside for those goals, and where does this portfolio fit in? Because once we know that, we can give a recommendation. And in this situation, we may recommend a 80% stock, 20% bond allocation, because she doesn't have a need for this money for living expenses, and it's more a legacy asset. Now, that could be our recommendation, but the client could say, I'm really not comfortable with that because of X, Y, and Z. Great. There's not a right and wrong answer to portfolio allocation. There's truly not. It is definitely risk tolerance, comfort level, and things like that. But it's not, you can't Google it, I'm 65, what should I do? That's probably not going to give you the right answer, truly, okay? So that's kind of our thoughts on its time horizon and income needs that really sets it. So I have one fun stat on that. If we go back to the S&P 500, we talk about time horizon. So if we just take any 1 year period over the history of the S&P 500, it has about a 73% chance of being positive over that 1 year period. So that's pretty good. And if we stretch it out a little bit and say over a 3 year period, it's about an 83% chance of being positive. 5 year, 87% chance. Over a 10-year period, 94% chance. Okay. So what we're saying there is if your time horizon is around that 10-year range, that's why we're comfortable. Plus, recommending a higher equity exposure. Okay. That's just the S&P 500, US stocks, but that's what we're saying, that we like your chances of being successful if you have a longer time horizon. Okay. Especially being globally diversified and things like that. So time horizon is huge for us, given a recommendation, and the income needs. It's not I'm 50, I'm going to retire at 60, so I have to be ultra conservative at 60. Well, this teacher doesn't need her portfolio and she wants to give it to her kids and grandkids in her church. well, we can be invested differently going forward, knowing her objectives. So
I think the most important aspect you brought up is just every single person's different. But we see it all the time where we have individuals come in and meet with us, and it's human nature to compare. And it's so easy to just set yourself up and say, oh, I haven't saved nearly as much as my neighbor or my friend. It's actually surprisingly common to have somebody come in and say, I've only saved 100,000 or 200,000. I feel like I haven't saved enough for retirement. And then we dig into it, and they have a $60,000 a year pension with inflation increases. And then they also have a $20,000 Social Security. And you look at that and say, that's incredible. That is such a powerful thing for retirement. And you are in such a strong financial position. But it's that human nature of comparing yourselves to others when your neighbor down the road might have $1 million portfolio, but they have no pension. I think this is a very realistic example of seeing what your strengths are, seeing what you have, and not comparing, because not everybody's life and reality is the same.
I do like that too, on the comparison line of, you look at on the right, the project manager, comparing the, if they need an income from the portfolio, back to our previous slide of those drawdowns, it's so important when you're drawing income from your portfolio to not have those big losses. Okay. So it's not that, well, geez, I'm taking out 7% of my portfolio, I need to be aggressive to make 7% each year. It's like, well, no, because if that happens, if we need to make 7 and we need to do, an 80-20 split, and that drawdown's 40%, that hurts, especially early in retirement. This is certainly, your comfort level, but if you're comfortable spending down your portfolio, okay, there's a lot of different thoughts on this. If you start with $500,000, do you want to end with the $500,000? Okay. Or are you okay with it going down to 200,000, at age 95? Okay. Do you see what I'm getting there? That if you're okay with spending down your portfolio, well, then it's okay not to make 7% each year, right? That makes sense. If we're not making as much as we're taking out, and we're okay with that, we can have that discussion, because someone who's okay spending down their portfolio would arguably be better off reducing their deviation, their risk in their portfolio, to not have a -30 or a -40 at the start of retirement. So, and that's just for the example of, it's not a one size fits all. It's certainly not based on your age. And there is certainly gray in here. Okay. But there is an answer. So don't be lost. We do give our clients an answer and say, this is what we think we'd recommend. And clients, obviously have a say as to, I'm not comfortable with that because of X, Y, and Z, or how it should be, but it's not a one size fits all. So.
All right. Well, I think we're getting close to the end here. I think we have one more slide.
Yep.
I'll jump into it here. We have just a basic question: why should I use a portfolio manager to help in managing investments? And I'm going to oversimplify this here. There's a lot more behind the scenes, but we'll talk about 3 big pieces here that a lot of people have common questions about. So distributions is one of the #1 things that we see every single day. Somebody calls in, needs a $20,000 distribution for their car. We sell investments and transfer the money to their banking account so that they can do that. That process has a bit involved in it. And we have tools that can efficiently and effectively manage that and get that done. Rebalancing is something that we're constantly managing. Portfolios grow in different proportions. Equities might grow really rapidly over a 5-year span, and we might need to sell off some of the stocks to rebalance it. And so rebalancing, we do at a portfolio level individually, and we monitor it to make sure that these portfolios, to make sure that they're within the target they need to be. And if anything needs to be addressed, we take care of that. Now, to be direct and very honest about this, distributions rebalancing, while we do have tools that make it easy and efficient for us to manage, monitor, and take care of it, these are things that everybody can learn how to do. You can go out there, you can learn about the tools at your disposal to be able to manage and link your bank account, send normalized distributions out of it. You can monitor your account and determine when to rebalance it. These are things that are somewhat manageable. It takes a lot of time to educate yourself into doing this and to having some rules behind it, but it can be done. The other aspect, which really is meaningful to have an institutional investor or portfolio manager, is discipline. It becomes really, really challenging to not allow emotion to take over when managing a portfolio, especially from an individual standpoint. It's challenging to look at your account and see it down 25%. Imagine you have $1 million account and it drops all the way down to 750,000. It gets really challenging to say, you know what? It hasn't hit its target yet. I don't rebalance it at this moment, or I should only rebalance at this small amount. You might be sitting there saying, oh, geez, I've lost $250,000. I'm going to sell out of the entire thing to stop losing money. And that becomes really challenging in getting back into the market or missing out on the immediate reversal of the market. Staying disciplined and maintaining your rules, maintaining the way that you approach investing through these really challenging times can make or break a portfolio over a long period of time. And it's something that we see a lot of individuals, a lot of investors have challenges with. Looking at your 401k, like I said, when it's down really far, it's so easy just to look at it and say, you know what, click of a button, it's fixed. Everything's sold to cash. But it gets really hard to just manage that, get back into the market and not do it at the wrong time. Like we said before, hindsight is 20/20. Knowing when you should have sold is easy when you look at it in the future. But in the moment, it's important to stay invested. And if anything is addressed, just rebalancing it based on the way that you've built out your strategy, sticking to the financial plan. Those are the most important things about being an effective portfolio manager and things that we help out with all the time.
Mm-hmm. And this is by far where we have our greatest value to our clients. We feel is that, we get so many calls, especially when we're going through these couple of months or March of 2020. For those of you that remember, the market dropped about 35% in 5 weeks. And we got so many phone calls of just, Kyle, just talk me off the ledge. I know what I should do, but I'm freaking out and I need to talk to somebody to think this through. So like Josh said, the worst thing you can do when you're having, big losses or anything like that is actually sell out of them, because you still own those positions as long as you don't sell them. So as long as they recoup, which I think we all can agree that the market generally goes up and to the right over a long period of time. Now, year to year, month to month, it does a lot of different things, but over time it will recoup. Because remember, all your portfolio is a basket of companies that have stocks and bonds that you own. So as long as there's companies still making stuff, you're going to own pieces of those. So, and it should recoup. So this is by far where we have our greatest strength, and what we help people with the most is something along those lines.
Mm-hmm. I think the easiest comparison to make is the value of your house. And I know that we have a couple of our advisors who use this comparison a lot. You bought your house for $400,000 and a recession hits and the value of houses just plummets. Somebody comes to your door and says, hey, I'll buy your house for $200,000. You would look at them like they're crazy. You would never sell at the bottom of the market. It's the exact same way with investments. Selling at the bottom of the market means that you don't get to take the ride all the way back. And just riding it out and being a part of the experience is what gets you over the long term, the annualized returns that we had shown throughout this presentation.
Mm-hmm. We did have one question come in, and I will lay the groundwork and then I'll have you jump into Josh. So when you look at stocks to put in portfolios, do you look at them ethically? So this is a very hot topic question right now. First, we don't really do individual stock selection. So it's more when we're looking at building our portfolios with the ETFs and mutual funds that we use. So this is something called environmental sustainable governance. ESG is kind of the buzzword that you'll hear out there. The thing with this is everybody's definition of ESG is a little bit different. But we do have a portfolios built that do follow some ESG guidelines. So Josh, why don't you touch on those a little bit?
Yeah, absolutely. So like Kyle said, everybody out there has a different definition for what ESG means. And there are companies out there that that will say, you know what, we focus on socially responsible, and we make sure that all the companies, we hand select every single company and make sure that they have the most ethical values out there. You have other companies like us that focus on kind of a certain topic, a certain area, something that's easily able to be monitored. So we utilize climate change as our number one tool for ESG investing. So we have a sustainable portfolio, climate change portfolio that very closely resembles our normal portfolios. Our goal with ESG investing isn't to create something that is wildly different than our normal portfolios, but is very much so mindful of being impactful with the way that we invest for climate change. We've got a great piece that we put together that shows kind of the impact that it has. And I'm going to recall off the top of my head, I might not be perfect on this, but I believe it's about a 51% reduction in carbon emissions compared to just the global stock markets, the portfolio that we created. There are ways to kind of make meaningful impacts without going all the way down the rabbit hole of hand selecting different companies. So hopefully that answered the question.
Yeah, I think that was a good answer, because in that, just that question of ethically, well, everybody's definition of what is an ethical company is going to be a little bit different, right? So that's just an example of how all this stuff can be so much different from person to person.
Mm-hmm.
So with that, guys, we will open it up for questions. So like I said, you can type in the Q&A or the chat box, or you can raise your hand, and I'll give that a minute or two. And then I can also unmute everyone if they would like to ask a live question. So we'll hang out for just a minute or two. Hopefully you found this informational. Again, investing, guys, there's so much that goes into it, and we can go really, really deep and kind of glaze everybody's eyes over. But our goal of this was just to give you kind of a little bit deeper than you might hear on a regular basis from us of why we do the things that we do. And for those of you that have been clients of ours, we also do our quarterly market commentary as well, quarterly conference call with clients. So that's another great place to look, listen into, because we go through a lot of this stuff in more detail as well on there. So with that, doesn't look like we have anybody typing in any questions. So I will unmute everyone, and we can actually see if anybody has any live questions. We went close to our hour, so I apologize. We were a little closer than what I was initially thinking, but that would be okay.
Nate and I are fairly talkative, so that's not a bad thing, right?
Not at all. All right, good. All right, so everyone should be able to talk if they would like. You might have to unmute yourself. I think it automatically puts you on mute, but if you want to unmute yourself and ask a question, we'll go ahead and open it up here for a second. We have a question. Is there an account minimum for a client? So the quick answer is no, because we have those two different divisions. It depends on what you're looking for from us. So in our KIP division, our cost investment portfolios, where we actually build the portfolio, do the trading, all the rebalancing and stuff, as Josh was mentioning, we do have an account minimum for that, that size of account. But we do have our Klaas 360 for people that are just wanting our information and kind of bouncing ideas off of us. So there's really no minimum for that. That division, we just charge an hourly fee to meet with us as we kind of give you our thoughts on where you should be. And then you would take your account at Vanguard or Fidelity or Schwab, wherever it's at, and implement that. We would be happy to sit with you if you obviously have your online login and stuff like that, and kind of help you implement them, but we would charge an hourly fee for that. So I didn't answer it completely, but there's kind of two divisions. So in one side, there is no minimum, and one side, there is an account minimum for us to actually manage the accounts. The reason we have to have a minimum, guys, is because it does cost money to place trades and do the rebalancing and pay for our team and our analysis and all that kind of stuff.
Kyle, what would you say is roughly the roundabout kind of a starting place for having us manage an account or the entire portfolio?
Yeah, typically, so because of the fee that we charge in our cost investment portfolios division, it's really got to be somewhere in the 100 to 125,000 range for it to make sense as far as not being too exorbitant of a fee. The fee is around 1%. But again, we do have a minimum fee that people would have to meet if their account minimum is under that. So really, we like to see it somewhere between 100 and 125,000 for us to actually manage it. Good. Another question coming in, something we've heard about the market. What amount of time in your experience is a reasonable cooling off time before we might want to talk to you about our portfolio? Well, we're always open for questions, guys. So please don't be afraid to reach out to us. Give us a call. We'd be happy to talk through it with you. But especially when we're going through things like this right now, with every day it's something different, and every couple of hours right now it seems like it's changing. So, so like I said, many times what we're going to tell you is we'll just talk you off the ledge because we don't want to make any sudden moves when we're going through things like this. The reason I bring up March of 2020 for everyone is that market dropped somewhere around 35%, depending on what you look at, over a 5-week period. By the end of the year, which was basically 9 months later, it had returned all of that 35% plus another 15 to 20, depending on what you're looking at. So again, that's over a 9-month swing. It had basically a 51% change from down 35 to up 16. So the worst thing you can do is sell at the bottom and then say, I'm going to get back in when things cool off. Well, what does that look like? Is it when the market's already recovered 2%, 3%, 4%? Because now you've missed out on a little bit of gain that you've already stomached on the way down. So to answer your question, always feel free to reach out to us. We'll be happy to talk through things with you at any time or shoot us an email. And then if there's obviously something more pressing, like I said, we'll be happy to talk through it with you. But a lot of times our guidance is going to be the same, and that don't make any rash decisions. We'll help you, and we'll talk through whatever concerns you have. And we can make changes. It's not that we won't let you make changes. It's your money, guys. You're going to be able to do whatever you want through us, but we're going to try and do our best to give you our guidance because we believe that's what you pay us for. And like Josh said, discipline is one of the biggest things. Behavioral investing, behavioral finance is what we're big proponents of. And sometimes that's the hardest part. These numbers may look real intimidating and that kind of stuff, but there's a lot of science to kind of help set up portfolios and things like that. But it's behaviorally being able to carry it out can sometimes be the harder thing. And we're all human beings, and that's what we want to help you with too. So
I would say that it's not, and I know as an investor, you may hate that answer of, just hold on and things like that. That doesn't seem to be helping. But, we like to say, don't confuse activity for progress, right? Sometimes, something goes down, we want to make changes and we think we're helping, but it's almost like you're stuck in snow or mud and you're just spinning your wheels, right? Just because we're making the wheel go around doesn't mean we're actually getting out of the ditch, right? Okay, so, there is a reason, all activity doesn't lead to progress is what I'm trying to say. Okay, so, it may sound like we're just beating around the bush, not really helping, but, over the long term, we do think we're actually helping by potentially not suggesting a change. So
to add in one piece, a situation that you should absolutely pick up the phone and say, hey, we might need to have a discussion and change our portfolio is when your financial plan changes. Something big in your life happens. Those are the things that we concentrate on as being the right time to talk about your portfolio. Now, by all means, call if you're nervous about the market and you want to get talked off the ledge or kind of see if it's appropriate to change something. But by far, the most times that we see portfolios shift or change is when something has happened in your life or you change your goals or change the plan in general. Those are the moments when it's the right time to pick up the phone or to talk in person and discuss about making changes.
Yeah. And either way, we're here to support everybody. So, if it's like Kyle said, it's your money. And if you just say, hey, I'm not comfortable with this, then that's the answer. You know what I mean? At the end of the day, we're here to support you, whatever, you choose to stay invested or make a change, differently. And it's not an on and off light switch. Okay. Just picture it on a dimmer. Okay. We don't like going from on to off. We like, if you're saying it's too bright, I can't handle it. Well, we can dim it. Okay. We're here to support you, but let's not do the on and off thing. Okay. The on and off thing does not work. So.
Yeah.
All right.
Well, good. Any other questions? All right. Doesn't look like it. Well, thank you everybody for attending our webinar. Hopefully you got some good information out of this. It's pretty timely with everything that's going on over the last couple of months in the market. So please feel free to reach out to our office if you guys have any questions. Like I said, we will be posting this on our website, and we can send out a link to those that came as well. So that way you can refer back to it if you need to. So other than that, thank you, everybody. Try and stay warm, and hopefully winter doesn't last too much longer, and give us a call if anything comes up. All right. Thanks, everybody.
Thank you.
Bye-bye.